Hey everyone, this is Kirk here again at OptionAlpha.com, and in this video we're going to talk about options parity. So options parity, we all know that options are a wasting asset, right? This is the time premium of a typical options price, right? It has slow time decay in the beginning half, 90 to 60 days. Once we start getting inside 30 days, time decay really speeds up, and then obviously as we get closer to expiration, it really exponentially speeds up the time decay wasting asset portion of an option. So what option parity means is that the option is basically trading at its purely intrinsic value, i.e. there's no time left. That's what it means when you hear that an option is trading at parity. So this usually happens when there's little time left until expiration, like we were talking about, or in deep in the money options far from the market's current price. They'll typically act just like the stock. They'll have a delta like the stock. They'll have virtually no time decay left in them, no volatility. It's so far in the money that it's pointless to have any sort of other value because it already is basically acting like the stock. So on a profit loss graph, the parity of an option is basically what you always see when you see all of our videos that have this expiration line here of an option strategy. So this option strategy, for example, in this case, this would be a short call. This option strategy, this is the parity graph. This is the graph of just purely the intrinsic value of the option at expiration. That's really what we're concerned about as option traders. Here's another quick example. Let's say that, and I just pulled up this quote here earlier this morning when I was building this video tutorial, but let's say that we have an option that's trading at 126.05 and we wanted to buy a 120 call that's trading at $6. Notice that there's really no value other than the difference between the market price and the strike price. So it's basically trading at its intrinsic value, or the value of basically how it would if you had owned the stock at 120. So that's what option parity is. It's just that difference. It's just the fact that the option is trading basically just like the stock. Remember that options are a wasting asset like we talked about and lose value as they near expiration. So what's left of them at expiration is just the intrinsic value. For in-the-money options, this is the difference in the strike price and the stock price, just like the chart that we just went over at 126 and 120. And for out-of-the-money options, there's no value left since all of the options value is made up of time value and really volatility. So that's where that pricing diagram really helps. That's basically option parity at expiration. Really remember that options only ever lose their time value. They never gain time value. They only ever lose time value. So options are continuously working towards parity at expiration. Now, some of the deeper out of the money options, like we talked about, they'll already be at parity, and there's really no point in trading those unless you want to own the stock there. But you can always check the intrinsic and extrinsic value of options on any options pricing table. So hopefully this was helpful, and as always, thanks for watching. Please take a second to share this video right below here on any of your favorite social networks with your friends, family, and colleagues.